Well, good afternoon. Happy Friday, April 4th. Mark Milam here, your mortgage professional. You can't go anywhere these days without hearing about tariffs. And tariffs have certainly caused a lot of market volatility, not just the stock market, but also the bond market, mortgages being very closely related to the 10-year Treasury in the bond market. We'll talk a little bit about that. Let me flip the screen around here and I'll show you what's been happening in the world of mortgage-backed securities. So on the whole, we actually improved a bit this week. Mortgage-backed securities moving up in value, although today, right now, currently, not a particularly good day. But let me call your attention, if you can squint into your screen and see these very thin lines right here. There's one there, there's one all the way up here. These thin lines represent the full day's trading volatility for these mortgage-backed securities, each line representing a day. And you can see here, the full day's trading is a lot. There's a whole lot of movement going on in mortgage-backed securities. At times we've been all the way up here where mortgage-backed securities are performing really well. Interest rates should be improving, but you can see as of 2:11 p.m. Eastern time, mortgage backs are now selling off, which means interest rates are worsening on the day. This is all around the tariffs. And really, when we start talking about these tariffs, we've got what the market anticipates, what the administration actually does, which is sometimes very different from what the market anticipates. And then you've got the unexpected or maybe unintended consequences, which are these retaliatory tariffs that come back on us from China or from other countries. And so there are a whole host of factors here that are very dynamic, and it's difficult for the stock market and the bond market to get their arms around exactly where things are because they can change at a moment's notice. Either we may change our policy as a country on tariffs, or other countries in response to us may change theirs. And trying to anticipate, which is what markets do, they're very anticipatory. They're trying to anticipate the full effect on the economy, and markets have a tendency to overreact just a little bit. Now, investors in the mortgage space, which are heavily influenced by the bond market, they've been holding back a little bit. And some of this holding back is a predictable outcome of this level of volatility. Think about it, if you were lending money into a marketplace like this where there is so much volatility, would you cut it down to the razor's edge and have the slimmest of margins, or would you potentially hold back a little bit? That's what we're seeing across the board, whether it's a big bank like a Chase or a Citi, or even boutique investors out there. We're seeing a little bit of restraint in terms of passing on pricing because at any given moment you may see a hard reversal like we've seen today, and all of a sudden those gains are given back and you see the market start to deteriorate. So volatility is the name of the game when it comes to this tariff noise. If we can look through or listen through the tariff noise and pay attention to what's happening underlying with the economy, we really need to focus in on labor. Let me flip my screen back around and let's chat about labor a little bit. So I'm going to scroll down here and go back to earlier in the week when we got the JOLTS report. That's job openings, labor turnover, came in under expectations. That's good news. Maybe not a huge miss to the downside, but certainly on the right direction of the estimate. ADP, we kind of discount ADP. ADP pays, I believe it's 1 in 6 people who receive a paycheck get it from ADP. So it's certainly a worthwhile metric, but not the end of the game. Today was the big day in terms of non-farm payrolls. Came in at 228,000 jobs created in the past 30 days against an estimate of 135. That's a miss to the high side, not exactly what we want to see. But unemployment did tick up from 4.1 to 4.2. Now, unemployment about 90 days ago was at 3.9. So we're really starting to see unemployment start to gradually move up as the weeks move on, as we move further into spring and further into this administration. But let me go back to that non-farm payroll number, because that's an important number to think about. That's really the big kahuna as it pertains to mortgage rates if you strip out what's happening with tariffs. And I'm going to move this out of the way, and I'm going to go to my own personal chart of record keeping around non-farm payrolls. Let me blow this up a little bit. I'm going to get over here to the right-hand side because these are the most recent. So this was January, and the headline number said, hey, we created 143,000 jobs in January. Well, we just revised that for the second time today, and the truth be told, we actually created about 111,000 jobs in January. So these go through 2 rounds of revisions. We got the first round in February, we got the second round just now, and so now we know what's going on with the January jobs report. We finished out with 111,000 jobs created, 0 job creation in the government sector. Here's February. We started out creating about 151,000 in February. We just got the first revision there, and we actually revised down to just 117,000 jobs created. But take a look at this. If you strip out government, we actually created more jobs in the private sector. Government jobs actually contracted by about 10,000 in February. That's no surprise given what this administration has been doing with DOGE. And then here we move into March. And so we get this headline number at 228,000, but you have to start to put a question mark around these numbers because they're getting revised down consistently, and we've seen this over time. If we go back even to the prior administration, we see ample evidence of the revision to the non-farm payrolls coming in far below what the original number was. So this 228 number is one that I would take with an asterisk next to it and perhaps a question mark, and we'll see how the revision plays out next month. You can see if we strip out government job creation, we actually created more private jobs. Government jobs subtracted about 4,000 in the month of March. So overall, we're seeing a softening labor market, and ultimately, while that's not necessarily good for the average consumer, it is good for mortgage interest rates. It allows the Fed to take their foot off the gas by keeping rates higher for longer. And don't be surprised to see some pressure on the Federal Reserve as we move toward the mid-year point to look at cutting the Fed funds rate, perhaps in June. We'll have to wait and see how those odds play out. But for now, if we continue to see softness in the labor market, odds are the Fed will revisit the Fed funds rate. They'll take their foot off the brake and resume cutting as they had done in Q3 and Q4 of last year. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.